Imagine waking up to discover that a single company is attempting to rewrite the rules of global finance by demanding a $1.75 trillion valuation right out of the gate. That is exactly the reality facing Wall Street and everyday investors this week as Elon Musk moves SpaceX toward its historic public debut. For 24 years, the aerospace giant operated as an intensely guarded private sandbox, leaving retail investors completely locked out of its massive growth. That long-standing era of isolation officially ends on June 12, 2026, when the company lists on the Nasdaq exchange. The sheer scale of this move is unprecedented. According to the revised S-1 prospectus filed with the Securities and Exchange Commission, SpaceX is breaking from standard corporate tradition by bypassing the usual preliminary pricing range altogether. Instead, they have locked in a single, unyielding fixed price of $135 per share for a total issuance of more than 555 million Class A common shares. If the company successfully hits its target of raising $75 billion, it will completely dwarf the previous record of $29.4 billion set by Saudi Aramco, instantly positioning SpaceX among the top 10 most valuable publicly traded entities on Earth. The immediate public reaction to this disclosure has split the financial community and social media into two fiercely competitive camps. On TikTok and X, viral clips from prominent retail trading influencers are framing this as a generational wealth opportunity, driving massive engagement by walking viewers through the unusual allocation process. Unlike typical high-profile tech debuts that cater exclusively to institutional banks and hedge funds, SpaceX has made the deliberate choice to reserve up to 30% of its total shares for the public through platforms like Robinhood, SoFi, and Charles Schwab. This specific detail has triggered a massive surge in subscription requests, with retail investors scrambling to secure an early stake. Simultaneously, a far more skeptical debate is raging across financial forums and YouTube analysis channels regarding the company's actual balance sheet. Independent analysts have pointed out a glaring, multi-billion-dollar contradiction inside the S-1 filing. Despite bringing in $18.67 billion in revenue, the entity is actually reporting steep net losses. This deficit is directly tied to a massive corporate event from February 2, 2026, when Musk officially merged his artificial intelligence startup, xAI, into SpaceX. Online critics and pension fund managers are aggressively questioning whether the staggering $1.75 trillion valuation is fundamentally justified, or if regular investors are being asked to subsidize an incredibly expensive, capital-intensive AI data center expansion alongside the massive development costs of the Starship rocket program. This situation escalated so rapidly because it represents a complete reversal of Elon Musk's long-held business philosophy. For over a decade, Musk insisted that SpaceX must remain private until regular, predictable flights to Mars were achieved, arguing that the short-term quarterly demands of public shareholders would inevitably conflict with long-term interplanetary goals. Bringing the company to market now reveals a deeper shift in modern billionaire and influencer culture, where the boundaries between corporate infrastructure, personal brand power, and retail hype have completely dissolved. Musk is leveraging his immense personal celebrity and the current cultural obsession with artificial intelligence to command a premium price tag that traditional aerospace fundamentals simply cannot support. By tying xAI's autonomous systems and satellite communications infrastructure directly to the core launch business, SpaceX is being marketed not just as a hardware company, but as the ultimate cross-disciplinary tech bet. This hyper-aggressive strategy will fundamentally reshape Musk's reputation, depending entirely on how the market reacts once the opening bell rings. If the stock holds its fixed price or surges post-listing, it solidifies his status as a financial architect who can successfully dictate terms to Wall Street on sheer bravado and vision. However, if the stock stumbles, due to the weight of those multi-billion-dollar AI losses, it will trigger intense scrutiny over his corporate governance, especially regarding the tight control he maintains over the company's voting structure. With the final IPO pricing set to lock down on June 11th, the world is left watching a massive, high-stakes financial experiment that could either redefine public investing or serve as a cautionary tale about the limits of absolute corporate scale.